Good morning, good afternoon, good evening, YouTube. We are back with another video. We are going to quickly run through income taxes. This is the season for income taxes, and I had a couple of questions from my coworkers. They asked me, since they have a kid who has a job, should they have the kid file a return on themselves, or should they add the kid to their return? And I said, well, you should calculate them both out to see which one is better. Point of this particular video is how much is being withheld from your taxes. And when you think about it, you are letting the government borrow a portion of your income to do whatever they do with it, right? And then they're holding on to it and they give it back to you at the end of the year or at the beginning of the year when you file your taxes. So essentially you are loaning the government your money, 0% interest. You loan it to them, they're giving it back to you with no interest. That is why this is titled Quit Loaning Your Hard-Earned Dollars Interest Free. So we're going to look at the withholdings today. Now what happened was when they changed the tax law that's currently in effect, they got rid of the exemptions, for one. And the exemptions were basically each person in that household, you got, it was deducted from your income. It was that portion of your income was exempt. And I believe when it was last in effect, I think it was around $3,800 per person. But let's use a round figure like $3,500. So if there was a family of four, there would be four exemptions at $3,500 a piece. That would be $14,000. And if you took a $64,000 income, subtract the $14,000 off the top, you now have $50,000 of taxable income before deductions. So you had your exemptions, and then you had your deductions, and you had a standard deduction. And if you met a certain threshold, you can itemize deductions to go over the standard deduction. So anyway, they got rid of the exemptions. And by doing that, they also increased the standard deduction. So now the standard deduction for a single person is $12,200. And for a married filing joint, it is $24,000 even, I believe. And I'm not sure what head of household is, but if it's not the same as married, it may be around $18,000. But really what I want to focus on is what's being withheld from your paycheck. And if you guys are familiar with the W-4, you should be. That is the form you filled out that you put the number of allowances, and that would determine how much they withheld from your paycheck. And the system was kind of silly because it didn't match up with the actual exemptions. Like you could put 9 allowances, so they hold out very little, because when it's time for you to file your taxes, you had, a good amount of deductions, you had your exemptions, you may have only had 4 exemptions, but because you didn't want them to take so much out of your paycheck, you claimed 9 allowances. There's now a tax estimator on the IRS.gov website we're going to look at, and I'm going to unpack the tax table so you can kind of estimate how much the IRS needs to be taken out of your check so you don't get a tax return, or you get a very, very little minuscule tax return. So let's check it out. A little bit of history. The income tax was established in 1913. I was doing some research on this. I believe it actually started or was introduced in 1910. And once it was ratified state by state by state, that time frame ended up being 1913 is when it was actually ratified by something like 42 states out of the 48 at the time. So, and yes, there are snakes in Congress. So here's the 16th Amendment. 16th Amendment. This is a thing that established the income tax. It reads, the Congress shall have power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. So this little amendment, this little paragraph It's what allows the federal government to have their grimy hands in your pocketbook, in your wallet, to snatch away your dollars to use as they see fit. All right. And here is the tax table. So this is what I really want to unpack. A lot of people don't understand. We have what's called a marginal tax bracket, a marginal tax system. And this shows you the marginal tax rates. It has changed over the years, but currently these are the rates. And what you have to understand is each bracket is set up so that your percentage, your income, how it falls in the bracket, that portion of your income is what gets taxed at that rate, right? Under that, I like to start from the higher numbers that work my way down instead of the lower numbers that work my way up. So for instance, if your taxable income, and I'm going to unpack what taxable income is and how you figure that, but your taxable income. So if you make $89,000 a year, that's not your taxable income because you have a standard deduction. So you have to take that off the top. But let's just say you have a $89,000 taxable income. The total $89,000 isn't taxed at 24%. Roughly $5,000 of it is taxed at 24%. The next bracket from $39,476 to $84,200 is taxed at 22%. And the portion of the $89,000 from $9,701 to $39,475 is taxed at 12%. And the last $9,700 of that $89,000 is taxed at 10%. Let's look at some examples of how you can estimate what your tax withholdings should be by estimating what taxes you have due at the end of the year. So this particular one I've already laid out. I did it earlier, and we're going to do one on the fly after this. And what we'll do is we'll pull up the tax table to see how close we are, to see if our estimation is correct. So here you have an income of $70,000, and this particular filer is filing status of married, filing jointly. All right. So the gross income of this person is $70,000, and we know we have a standard deduction. And when they raise the standard deduction to $24,000 for married, that pretty much eliminated the majority of filers that would claim itemized deductions, because that's such a high standard to meet. $24,000 in itemized deductions is very high. So anyway, this gross income of 70, we're going to take off $24,000, the standard deduction. That leaves you with a taxable income of $46,000. So let's see how this plays out in our tax table. We can see that the $46,000 falls in the 22% tax bracket. But again, we have to go by the marginal rates for each bracket. So taxable income from $46,000 down to $19,401, right? That total income is $26,599, right? This right here, basically, this subtract from that gives you the total that's being taxed in that bracket. Okay, lost my position there. So back to what we were saying, taxable income, $46,000 to $19,401. The total amount of income in this range is $26,599. And that is going to be taxed at 12% because it falls for married filing jointly in the 12% bracket right across here. $26,599 falls here. So that total 12%, the taxes due on that is $31.92. So the rest of the amount from $19,400 down is 10%, and that's going to be $19,940. Let's run through it again. The taxable income is $46,000. That's the taxable income after the standard deduction. the income range is going to start at 19,401 to 46,000 here in this particular bracket. So it starts at 19,401 to 46,000. That total amount in that bracket from here to here, the total amount of income that is 26,599, which gets taxed at the 12% rate. So the total taxes due for this amount is $31.92. And then you take the second amount, which is the rest that's left over from the original 46, 19,400 to 0. And you know that's 10%, so you know that's always going to be $1,940, 10% of 19,400, right? So the total taxes due of this person's income of $70,000, when you add those two brackets up together, should be $51.32. So how do you check that? Well, you go to the irs.gov website and you look at a tax table. So we're going to quickly go to the IRS website and take a look at the tax table. All you do is go to irs.gov and you can type tax table in the search and pull up the tax table here. So we determined that a person making $76,000 gross income after the standard deduction has a taxable income of $46,000. So all you do is take that taxable income and you find it on the table, 46 right here. And we see that for married filing jointly, you pull up that column, 46,000 is 5135. And we calculated 5132. So we are right there at it. Okay, so that's how you can tell if you are withholding too much from your paycheck. For instance, if you were withholding, say, $400 a paycheck, which is $800 a month roughly, then that would be about $9,600 withheld for the year. And if you were in this case where you made $70,000, that means you've overpaid by about $4,000, and that would be the refund you can expect to get, which would be insane. So let's do another one on the fly. Let's say income is, let's do like a single person. Let's do 36,000. And we're going to do my filing status will be single. No, let's do a big number. Let's do 136,000. Filing status single. That way we get more brackets included. Yeah. So gross income is 136. And we're going to subtract the standard deduction. This person is single, so only $12,000 is coming off the top of their income. So that taxable income is 136 minus 12, which would be 122, 124, 124,000. Dollar sign, right? 12 plus 2, yeah. So taxable income is $124,000. Nice. And because they fall in the single, they're going to start out in the 24% tax bracket. So that means the income from 124 down to 84,201 will be taxed in that 24% bracket. So let's see what that total is. Let's get the calculator. And it's 124 minus 84,201. That's 37.99 in that bracket. 39,799. 39,799 in that bracket is being taxed at the rate of 24%. It's 24%. So what is that? Times 0.24 That's $9,551. We rounded to 9,552. 52. So the next bracket is, let's see, we're single and we are here. The income from 84,200 down to 39,476 is going to be taxed at 22%, but let's see how much income that is total. 84,200 minus 39,476, that's $44,724. $47,244. Did I remember that right? 44,724. Dyslexic with the numbers. 724. And like I said, that's going to be taxed at 22%. And we take that number times 0.22. That's $9,839. Woo. $839. Okay. Now we have the income from 78,950 down to 19,401. And the total that bracket represents is, I'm looking at the wrong one. Looking at the married one. Thanks for correcting me, guys. 39,475 to 9,701. And I'm speaking to no one when I said that, to myself and the other people in my head, apparently. So we need to figure out how much that. Having fun with numbers. 39,475 minus 9,701. That is approximately $29,744. And that's going to get taxed at 12%. Almost to the finish line. And that total tax due on that amount is $35.73. And then, of course, the last one, we already know because it's 10% and it's the last bracket down to zero. That total is 19,400 and it's at 10%. So that means it is $1,940 due for that level. So the total of all this madness for this person, his or her total tax bill will be the grand total of $95.52 plus $98.39 plus $35.73 plus $19.40 equals $24,904. Yay, you, buddy. So this person would have to withhold, if he gets paid or she gets paid 26 pay periods, about $957 out of their paycheck every pay period to make sure they can cover their tax bill. I have to interject another video because I forgot to go and check on our calculation here with this last example. So the taxable income was $124,000, and we said the taxes due on that was $24,904. So we're going to go and check that. $124,000 for a single person. Scroll. Oh, look, there is no 124. Well, why is that? I don't know. Has to be a reason why, so let's see what it says. 98,000. Oh, use the tax computation worksheet. Well, we're not going to be doing that. So, oh, well, it's the same thing we just did. Yeah, it's the same thing we just did. So, unless they change, let's see. Let me see if I can see something. Taxable income is at least 100,000, but not over 160. That's 24%. Enter the amount from line 11B. I'm gonna calculate this out and see. Let's because it's gonna satisfy my curiosity. Curiosity killed the cat. What was it? It is 124, which is definitely between 100 and 160. So it's 124,000 times 0.24. That's 29,760. Okay, guys, apparently something happened where the video stopped before I could finish that last computation. So let me just pick up where we left off. So we were calculating $124,000, and because the tax table only went to 98, there's a special computation that you have to perform here, which is basically what we were already doing. But because the person is over $100,000, there's there's a little special thing that's going on. So the taxable income we determined was 124,000. My calculator keeps closing. It was 124,000 taxable income. And what you are to do is multiply that times the amount of 24% times 24. That leaves 29,760. And then you take that amount here from C, which would be this 29,760, and subtract 5,825.50. 58, 25, 50. And that get what the 29,760 minus 5,825.50. So this is going to be this person's actual tax bill, $23,935 after rounding. So let's compare that to what we had calculated. It's a little bit less. So you actually come out a little better by a little bit if you are over $100,000 in taxable income. So I hope that helps you guys. And if you have any questions, just leave a comment. So back to the video so it can finish. We'll see you next time. So that is a quick exercise of how it all works and how you can estimate. If you know your filing status, you know your income, you could take a look at the tax table and figure out how much tax you need to withhold, how much income tax you need to withhold from your checking account, good grief, from your paycheck. Now, back to the original point of this video. If too much is being withheld from your paycheck, you need to adjust your W-4 so that they are not taken out so much. Ideally, you want to end with a zero balance. Nothing is owed and nothing is being returned to you, right? You don't owe the IRS anything. The IRS doesn't owe you anything. Make it like 25, 50 bucks. That would be ideal. So I hope this video was helpful. Because it's tax season, I will be doing more of these. I'm going to look at that tax estimator on the next video using some real world W-2s so we can look at that and see how that works. All right. So thanks for watching. Please make sure you subscribe, like, share, leave a comment. I should get some comments now rolling since this is tax stuff, because people always have questions about taxes. And I'll be happy to engage you. And we will see you next time, guys. Thanks.